Been a pretty miserable session so far for oil. Goldman Sachs has cut its price forecast for crude for the third time in 6 months. Our guest sees oil as a buy right now. We are joined by Phillip Streible, Chief Market Strategist at Blue Line Futures. Phil, great to see you. Thanks for giving us the time. You see oil as a buy below $70 US?
Yeah, on the December contract. So we want to have some time on it. We want to see how this, recession plays out that we're anticipating, whether it's a soft recession. We think that oil prices will end up naturally finding their floor. I think that Goldman Sachs cutting its price target for the end of the year is giving us a great opportunity to add to those positions because much of everything that was discussed within their note has already been factored in. So crude oil's got a nice price band, $65 on the low side, 85 on the upside. You do look at the inventories that we have. We have 459 million barrels on hand, the 5-year average 469. If anything unfortunate happens, Saudi continues to cut, Russia fails to keep flooding the market with cheap oil, you could see that price snap back quite a bit.
But you would tend to go with the longer dated futures on oil right now to let things play out?
Yeah, 100%. On most of the commodities that we're engaged in or the recommendations we're putting, we want to have some time on it. These are long-term developments. It's not just a sharp snapback. If we were going to play like an inventory report or something like the Fed, the jobs number, things like that, that's when we start to see more volatility with the front month. But I think the December contract gives people a long enough timeline to get through into the back of the year when we are anticipating the Fed will get more accommodative.
Similar story for gold. You say there's a real possibility gold gets to 2,500. I mean, that would be new record territory in nominal terms anyway.
Yeah, because we believe that the playbook that the Fed is using is similar to that in 2018. In that hiking cycle that they had, they were raising rates. But once you got to the December meeting in 2018, they said that they were going to raise rates 3 more times. Well, what happened was we saw peak GDP, we saw a slowdown in the U.S. economy, and then the Fed went on a interest rate cutting cycle. That's what took gold from its lows from 1350 on up to 2000, where it tested it for the first time. We were anticipating that the playbook that they have right now is very similar. Like they were anticipating a couple more rate hikes here, starting tomorrow and going out. Now that there's the chance of a pause, there's only a 25% chance that they do raise rates here tomorrow. If they pause, that should give a tailwind to a lot of risk assets. And if they go on to a rate cut cycle towards the end of the year, that's where gold gets its legs.
Do you think that's a real possibility? I know there's so many factors, but if the Fed cuts later this year, I mean, that would tend to ignite gold, I suppose, bringing down real interest rates.
Sure, you'll see the real interest rates, the 2-year and the 5-year, they'll decline significantly. The U.S. dollar should continue to weaken. It wasn't a bear trend for quite a bit, the U.S. dollar, and it finally broke out to the upside, but it doesn't look like it's going to extend that rally much more. So we're already seeing a lot of the other foreign currencies, Canadian dollar, Australian dollar, those are now starting to go back to bullish trends. They look really good, should weigh on the dollar index, and it could provide some tailwind support for the gold market.
Let's put up the U.S. dollar very quickly, just see how it's been doing. Maybe a 5-year for the U.S. dollar and then a 5-year for the Bloomberg Commodities Index if we have it. I know these commodities indexes are always tough. What is the weighting you give to oil? But yeah, for sure, the U.S. dollar well off its highs of late last year.
Yeah, it has come down quite a bit. So we think that the U.S. dollar will continue to travel, either side of par, and that should be what helps out a lot of these different risk assets. Everything from like silver, copper, platinum, all these different metals in energy should get a lift on that.
Sugar has had a great run. It's up something like 40% in the past year. You think that's overdone and sugar is set for a correction?
Yeah, basically what happened was Thailand and India, they had curbed their exports. They wanted to, keep sugar prices low within their country, and that's what caused that squeeze on the outside, anyone else who's purchasing it. Now with Brazil into harvest, Brazil is going to take over as one of the largest producer, and their production should be 48% greater than the previous year. If you see energy prices continue to weaken, you could see sugar prices sell off with it because of the correlation on the ethanol side. So we think that you want to have a balanced portfolio. You want to have longer term assets, things like oil that could work out, things where if there's a possibility of the economic downturn, gold futures take off. And then I think that an agricultural product like sugar to the downside would help out quite a bit.
Give us your take on corn, because more of the U.S. corn belt is going into drought. We could have a look at a 5-year for corn. Is enough of the crop going to be damaged, do you think, to really push corn much higher?
Fantastic chart pattern on the corn market today. It's up about 2.5%. It broke out to the upside. That's on the July contract. It has been quite dry. Every one of the farmers that I talked to throughout the Midwest is just really, they're just not getting any kind of rainfall whatsoever, or if they get it, it's very, very scarce. So it could impact that crop. They could have to, take some action here in the next, month and start replanting or things like that. So, that could really put some tailwinds behind the corn market. We definitely like that to the upside. And it's another one that works off of ethanol. So it would be a nice balance if someone was long corn versus short sugar as a pairs trade.
I'm just trying to think, because they use so much sugar for ethanol in Brazil, you mean?
Yes, down in South America. Same thing on the U.S. with the corn side, with its ethanol demand.
Right. What about wheat? A slightly different dynamic. In part, wheat driven by the prospects of Russia cutting off Ukrainian grain exports.
That's another thing that's similar to the reason why wheat prices are so low right now is Russia keeps flooding the market with cheap wheat. Any commodity that they're an active role in, they're using to, sell and undercut everyone else to help fund their war efforts. So, on the wheat, if you look across like Oklahoma, Midwest, the spring wheat, the winter wheat crops, they were all terrible. The crop ratings are extremely low. We think that wheat was a great opportunity on the long side. So really on all the grains, corn, wheat, soybeans, we have recommended long positions on all those. You could balance something with a short-term put option on something like corn, where if you do get any kind of drop in temperatures, increase in precipitation, you'll have that kind of knee-jerk reaction, and that's where you could profit from a short-dated option.